Hi, good morning, friends. Today we'll learn about stock options. I want to make it a very quick video. So, options, where the history of options starts in Greek with the olive harvest. They used to uh, buy contracts in winter, and when the olive harvest was better than expected, they used to sell those contracts at higher price in spring. Similar concept was applied to equity markets. Options are in two categories, as you uh, very well know, the calls and the puts. The buyer of the call is bullish, and the buyer of the puts have bearish view. Contracts, this is the definition of the call option. You can get a better picture on Google. So the definition of the call options, whether it is a call or a put, the definition of these come into picture if you exercise those options. I won't go much in details for exercising the option, although I have added the contents in these slides. So I'll talk more about trading the options. So I'm just reading out the definition. It's the contract between a buyer and a seller to exchange security at a set price. That set price is called the strike price, and the set date, is called the expiry date of the contract. Contract size, so it's not just one stock or two stock. In USA, the size is fixed for options, that is 100. In various countries it's different. In India, the lot size is different for different stocks. Any option will have three major components. This is the basic components: the expiry date, the strike price, and the premium. Similarly, this is for put. The put, the buyer of the put has right but not obligation to sell the securities at the strike price on a expiry date. Okay, so this is about put. Again, the lot size I told you already. This is an example of a call option. As you can see, this is the basic example I have given here. The strike, expiry, premium that you pay in dollars, and status, ITM, ATM, and OTM. ITM is in the money. If the price has already the current price has already reached the strike price or has crossed the strike price, it is in the money. At the money, if the current price is same as the strike price, as you can see, I'm saying 100 and it is at 100. If the current price has not yet reached the strike price, it is out of money. So this is just terms that is frequently spoken in the option market. Premium, as much as you go out of money, the more far you go out of money, the premium will reduce, but the risk will be higher. If you are in the money, the premium will increase. Okay, so for suppose today it's 100. In 2 days the ABC stock goes to 102, then again you are in the money and the premium will rise. So if you have bought it for 3, after 2 days, if the stock price rises, the premium may be 4.5 at that time. Okay, and remember the lot size is 100, so you have to multiply the premium into 100 while paying the premium of that option. Okay, so here I am saying the premium is 543. So when you buy this contract, you have to pay 500, 400, 300. It might be in decimals also, like 5.25. Then you have to pay $525, like that. There is another example of the call options. The change with previous slide to this slide is the expiry. The previous slide was 12th February, which is 4 weeks ahead of now. This is 19th February, which is 5 weeks ahead of now. In USA, the options of stocks expire on the Fridays. Okay, so all the Fridays, if the Friday is a holiday, it will be adjusted to Thursday. Now this is an example of put options. Here, out of money means you are bearish. You think that first of all, with the put option, you are bearish. You think that the price of the stock will go down. If the stock has not fallen down enough to reach the strike price, it is out of the money. For example, the stock fell from 105 to currently trading at 100. It has not yet reached 99 or 98, so 99 and 98 is out of money. It already crossed, it fell from 105, it already crossed 100, 300, 201, and now it is at 100. So 100, 300, 201 are in the money. Whenever it is in the money, the premium will be high. At the money, it will be there. And as you say, far out of money, the premium will be lower. So this is how what you're going to see. Again, you have to multiply the premium with 100 when you're going to pay for that option. Okay. And I have not kept that slide. If you go ahead in expiry, if you go into a March or a April expiry, the premium will be higher because you are getting more time. You are taking more time for the stock to fall or rise depending on the call option or the put option. Okay, now this slide, this is just I have merged the slides. This is the real picture how it will show when, how you can see when you open any real example. So you can see at the money is highlighted with bold. Currently the stock is trading at 100. So the call option and the put option both are at $5. If you go in the money for call options, the premium will be higher, 99, 98 and 97 strikes. If you go in the money for put, for example 100, 300, 201, the in the money strikes premiums will be higher, out of money strike premiums will be lower. Okay, it depends on we'll talk later whether you should buy in the money or out of money options. We'll talk about it later. Now trading call options, I don't want to talk more of about exercising the option. So exercising the option means when it is in the money at the expiry. For example, 2 days back on 14th January that the options expired. So the options which were in the money for any stock, those have to be expired, those have to be exercised. So you can do Google search or internet search for how to exercise those options. I have added my comments here, you can read them through. I want to make this video shorter. So for traders, you just buy the call options and sell it before the expiry. You don't need any large funds, you just need to pay initial premium. For example, if I think my ABC stock is going to go high, I will buy a call option of 102 strike with 19th February. I will pay maybe 300 or 400 depending on the premium required at that time. If the stock rises, my call option will rise and I will sell it before the expiry. Similarly for put options, how to exercise, you can do a Google search on it. With put option buyers, you can just buy it and sell it before the expiry. You don't need anything apart from the premium. Now this is a slide, very important and very interesting slide. Why options? Why you want to do options at all? Why not stick to stocks? So low upfront capital required, as you can understand very clearly. For buying 100 stocks of any script, for example Apple, if you want to buy 100 stocks, you need $13,000. If you want to buy an option contract, maybe April or March, you just need to pay maybe $700 for that contract. Today Apple is trading at 127. I think Apple will go to 140. Okay, so if I just buy 130 strike contract of April, I just need to pay maybe $700 or $800 upfront instead of paying $13,000. So that is low capital required. You can, since the capital is low, with limited amount in your fund, in your account, maybe $5,000, if you want to buy stocks, you can buy very low quantity, or in one stock itself you can buy say 25 or 30 Apple stocks you will get if you have $5,000. Instead, if you do options, you can diversify. You can buy 5 different companies, for example Apple, Microsoft, Facebook, Chase Bank, and one more maybe Verizon or AT&T. These companies contracts you can buy with options. You can diversify your portfolio. Limited downside, because if you lose, you lose the maximum you lose is the premium. So limited downside. Instead of losing, if Apple loses by 50% on some day, on some bad news, any stock loses, then you lose 50% of the 13,000. Here the option traders will lose just 700. Okay, so allows you for a strategic moves. If you think on a certain day, if you think Apple is going to go high in next 2 days, so you don't need $13,000, you just need maybe 600 or $700, and you can bet on 100 stocks to go up. uh, you can do lower risk trading with spreads. I'll talk about spreads in some other slides. Allows you to hedging your portfolio by selling covered calls or by buying puts. If you think market is not doing good, market is going to go down, you already have some shares and you don't want to lose all the money on your shares, so you can buy puts or you can sell covered calls. uh, Now this is the good picture I showed you in the previous screen for why to go for options, why not to go for options. There are reasons why wide fluctuation. Suppose in your portfolio you have all the calls, you don't have any puts, so your portfolio is going to get hit hard if the whole market goes down. That is one major risk. Then uncertainty of gains. On sometimes you will get gains, sometimes less gains. Okay, we there are components on the option which doesn't favor higher gains. We'll talk about it in later sessions. Highly risky. If you don't use stop loss, people here in USA, they go for weekly expiry of this week or the next week, and if they don't use proper stop loss, they lose the whole amount, the whole premium of $200-300. Commission rates might apply depending on the brokers, and short-term capital gain taxes. Options are always considered short-term capital gains, so those taxes will be higher. So that's all we have for this session. In next session we'll be talking more about the components of the options, like Greeks, IV, that is implied volatility, volume, open interest. So with that we'll get more clarity. Thank you for joining for this session. Thank you. Good day.